In today's video, we are going to look at using a whole life insurance policy to purchase some real estate. What we're going to look at though are life insurance policies designed for maximum cash value, but with fixed loan interest rates. What we're going to spend the majority of our time on is a policy with a fixed loan interest rate of 6%. Now, what's interesting about this is the same policy we looked at in our last video. It was a policy on a 40-year-old individual, funding it $100K per year for 10 years. In fact, let's take a look at it. What I want to add here is there's going to be a catch. And what I mean when I say a catch, you ever hear of the topic of non-direct and direct recognition? It has to do with how dividends are applied to a life insurance policy. So if it's a non-direct recognition policy, what'll happen is the dividend that you receive, if you've got no loans outstanding, say your dividend is $10,000, you receive that $10,000 dividend. Let's assume you take a loan out for the maximum dollar amount, or it's 50% of your cash value, whatever dollar amount it is. If it's a non-direct recognition policy, the company does not recognize the fact that you have a loan outstanding and you receive that same $10,000 dividend. A little bit different with direct recognition. With a direct recognition policy, the company directly recognizes the fact that you have a loan outstanding and they apply a different dividend rate to the borrowed funds. Keep in mind I said different dividend rate. It is not always reduced. Sometimes we hear that quite a bit. Depends on the insurance company and how they treat dividends with their direct recognition treatment. So how you can tell here is we are going to look at a fixed loan interest rate of 6% in a direct recognition case study. So let's take a look first. We will begin with year 10. Year 10, what's your cash value when you take a look at that? Getting close to $1.2 million. Total cash value, $1.18 million. However, what do you see in the dividend column here? Annual dividend and year. What do you notice? Let's look at year 6, because this is the year we're going to take a loan out. There's your dividend, and look at year 10. Dividend is $36,000 and change. So year 6, just under $20,000, $19,887. And then year 10, $36,000. Call it 20 and 36. 20,000, 36,000. 20,000, 36,000. Let's take a look at the loan illustration. Same policy. Values are identical the first 5 years. Then we take our $500,000 loan in year 6. What was your dividend in year 6 in the last example when we did not take any policy loans? Do you recall what that was? Just under $20,000. Look at this. $25,000 and change. We have a higher dividend payout. The reason why is because here we have a direct recognition policy where the company is paying a higher dividend rate on borrowed funds. That's right now, based on where interest rates are. This does change over time. We've got some content on this in our All About MassMutual video. But as time passes, we see consistency there. Same thing as year 10. Last example was $36,000. Here, it's $42,000. So looks great. Well, great in terms of dividends, a little bit higher here. On the flip side, what's the drawback, right? Don't just show me the good. The drawback is the fact that we have a higher cost to borrow. In our last video, we looked at this policy with a variable rate at 4%. Here we've got a fixed rate at 6%. 6% of $500,000 is another $30,000. That's the cost to borrow in this particular example. So let's continue on here. Take a look at a comparison sheet. Wrong button. Here's what I want to start with, the repayment scenario. So what we've got here to start, on the left, growth scenario. 100K per year going in. Annual outlay, 100K per year. Break-even point, year 4. Okay, looks great. Over here, loan and repay. There's your $500,000 loan. What's the impact of the policy loan? There's your cash value. So if you've got $111,000 left in cash value, think of it as remaining equity. I took $500,000 against my available loan. Hey, I see another opportunity. I've got to pay some additional expenses. I've got to fix the property up more. I've got another 100K in equity here that I can access. And what is collateralized is the death benefit. Now, we pay loan interest only, so $30,000 comes due each year. It is fixed, so it will not increase. We pay the $30,000, and in this particular example, we begin to repay the $100,000 per year, beginning year 11, and pay it off by year 15. In our last video, what happened, if you had a chance to view that? When the loan was repaid, your cash value and death benefit were 100% restored to exactly what they would have been as if you never took a loan in the first place. A little bit different here. Here's your cash value, $1,557,000. Over here, $1,507,000. You've got about $50,000 more in cash value. So as a result of the direct recognition policy paying a little bit higher dividend, what happened? We saw everything restored and some. Now, depending on what company and product you look at, sometimes it's the opposite. Let's take a look at a different company and product here. 5% is the actual cost to borrow in this example. Different product with a different loan scenario. So this example is with Guardian, the last one's with MassMutual, completely different product as well. A little bit less cash value up front, but what do we see here? $83,000 in the first year. If we progress to the left, it's not a 10-pay policy, it's a typo on my end. We should pull up the full illustration. We've got that in other videos. Year 1, 100K in, you've got 83%. By year 5, you've paid $500,000 in and you have $500,000. Scroll your eyes to the right. In the loan scenario, year 5, you don't touch it. Everything is identical. Now the next year, we're going to look to take a policy loan. So what is the impact if this is your money when you take that $300,000 loan? There's the $300,000 loan. Look at the death benefit. I like this example. It's a little bit cleaner because we don't have that increasing death benefit from the get-go. $300,000 loan is taken, and we see a $300,000 reduction in the death benefit. Remember, anytime we borrow against the policy, the death benefit is collateralized dollar for dollar. Cash value, there's the equity you have access to. So when we take that $300,000, we've got another $219 to be precise in cash value. Now in this example, we pay the loan interest only. Say 5%. If you pay the loan interest, it nets out to about 4.76%. Oddball number, right? So we pay the loan interest in the first year. Beginning the next year, we pay the interest and principal payments of $30K per year. Here's what I want to hit on. When that loan is repaid, your cash value is $806. That's by age 50. What do you notice over here in the example where you did not touch it? It's $831. So the last example, where the company raised the dividend rate on borrowed funds, we saw more cash value in the example where we loaned and repaid. In this example, we see a little bit less. So it is important to be aware of the company's provisions and how they treat borrowed funds, how they apply dividends. It also depends on when you started your policy. This is a new policy with Guardian. If you took one out last year or several years ago, it's completely different. We've got a higher fixed loan interest rate, and they apply a higher dividend rate on those borrowed funds. So you see a case similar to what we just looked at in the MassMutual sample. But it's interesting just to be aware of this, and it does help a lot of people refine their decision-making process. Granted, this is viewed sometimes as a small detail to some people, but when you add it up with other features such as Guardian's flexibility, MassMutual's ability to fund right up to the MEC limit for a long period of time, small details that are available or that I want to be aware of, it helps me refine the decision. So I hope you enjoyed this one. I always like talking about this stuff. If you did, please hit the like button, subscribe for more. If you have any questions or comments, please leave them below. I will certainly take a look. If you'd like to see any case studies, let us know. And as always, I hope this helps. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.